Joining us right now is Michael Arougheti. He is the co-founder, president, and CEO of Ares Management Corporation. It's, of course, a global alternative asset manager, $142 billion in assets under management, specializing in credit, private equity, and real estate. And we spent some time with your colleague, Tony Ressler, down in Atlanta, maybe now, about a month or two ago. Your reaction, though, to Jay Powell, did he make a mistake in what he was saying?
I don't think he made a mistake in the decision. I think in the communication, he probably could have been a little bit clearer. I know everybody likes to talk about the Fed. I think it's important to contextualize that in the real economy. And one of the things that we talk about around the tables of Ares Management, we have 1,700 middle market companies in our portfolio. We touch about 800,000 consumer loans. We probably touch 30,000 small businesses, and everything that we're seeing in our portfolio says that the U.S. economy is on unbelievably strong footing. So I think when we're talking about a rate cut, it always has to be contextualized not just about monetary policy mandate, but really what are we seeing in the economy.
That would argue that there shouldn't have been a cut at all.
Well, I think that could be why we're talking about it as a mid-cycle adjustment as opposed to a...
So you don't see anything? There's nothing you're not worried about a recession?
We are not, and I'm actually glad that the market is not talking itself into one.
When you say you have all of these consumer loans, you have all of these middle market companies, are they geographically focused in any part of the country, or are they pretty broad spread?
It's a very national footprint. Yeah. And I would also say most of the peers in seats like mine and bank CEOs that we talk to would tell you that their consumer books have never been healthier.
And so as a function of this then, are we at the end, though? I mean, are you thinking I got to harvest while things are good, or would you actually buy new properties at this point?
I think one of the challenges that we're trying to balance is when you're in such a persistently low rate environment, asset valuations are high. Right. So everybody who's in the investment business, whether you're in the public markets or the private markets like we are, you're trying to measure the health of the economy against some very high asset prices.
What are all these businesses responding to, Michael? Less regulation, a better tax environment?
I think the tax cuts have helped. I think we've got a very strong consumer, and if you look at the complexion of the U.S. economy, obviously right now it's a consumer and service-led economy. There's a lot of liquidity in the system. Inflation is in check.
Why?
Well, there's a lot of theories about that, and I think that's what's confusing some of the
Whatever it is, it's good. But is it innovation? Is it imported from Europe?
Some would say that we're importing it. Some would say it's the aging demographic and higher savings. Mm-hmm. I think there's an argument to be made that it's slack in the labor market, and there's more productivity there than we believe. I've seen some numbers that would tell you that technology is actually taking 40 basis points off of the core inflation rate. So I think it's a combination of all of those things.
You know, I'm feeling a little Chris Matthews-like here. There's a little chill or a little thrill up my leg.
I think that's the 68-degree...
yeah, maybe it is, because it's cold. No, but you're saying some really positive things that don't really make me think that cycles end from old age. They might end from mistakes.
Everybody likes to talk about that. One thing we know, it's I don't want to say it's different because we're going to have a cycle, but we have to be anchored in what we're seeing in the real economy.
You said that the real issue, though, is trying to figure out if asset prices are too high based on what you're seeing with these things. Are you buying anything right now? Is it in the private market or in the public markets?
We are exclusively in the private markets,
yeah.
So that makes it a little bit easier for us to navigate because we can spend 6 months, a year, 2 years making an investment decision and then improving the asset that we buy. So I think we probably have a little less anxiety than some of the public market investors.
Are you also selling things into the public market at this point?
For sure.
Yeah.
Yeah, and the valuation environment's conducive to harvesting as
What's interesting right now from an investment perspective?
Well, you know, where we're finding the most fertile ground, both in the U.S. and in Europe, is in the private credit markets. Obviously, given the low rate environment, we're just seeing an incredible amount of demand coming from institutional and retail investors for yield product. And if you're worried about valuation in the credit markets, you can come in at roughly 50 to 60% of asset value, if you will, and still generate some pretty attractive.
But what I'm getting from you is that the thesis that asset prices are ahead of fundamentals because of the Fed and because of low interest rates, that the underlying economy might actually justify some of the valuation, so I don't have to worry as much.
I think for now. So I think the risk when we're talking about prolonged cuts is that if we have 2 persistent of an interest rate environment, asset values could outrun the economy.
And it could be malinvest. I mean, I worry about that all the time. We saw what happened when money's too cheap and it goes places where it has no business being around the world.
That's the fine line. And I think, right now it feels like things are
as good as you're saying, then maybe assets aren't. Maybe they still justify.
We'll know when we know.
Right. I wanted to ask you a separate question about your business, or at least your industry. Yesterday, Carlyle announced this plan to become a C corporation. You recently announced plans to become a C corporation, along with Blackstone, KKR, and Apollo. And this all in an effort, I think, to get into some of these indexes.
Well, that's actually a secondary effect. I think it was all in an effort to improve the valuation and liquidity in these stocks. I don't want to get too wonky about it, but if you look at publicly traded partnerships, which is what we all were prior to Ares initiating the conversion string, 80% of public investors are unable to own publicly traded partnerships. Foreign investors can't own it for tax reasons. Individual investors don't want to own it because they have to have K-1s and it complicates their tax filings. Hedge funds can't own it for similar reasons. So when you really look at Blackstone, Ares, Apollo as publicly traded companies, we weren't really trading because we weren't investable. So the thesis was if we convert, whatever economic dilution there would be from the taxes, we would see a boost in the technicals.
But the change in the tax structure made this possible.
For most, yes. I think for Ares, we were uniquely positioned, which is why we were able to go first. We have such a high percentage of our assets not in PE that we were already paying corporate taxes on probably 80% of our income.
Has it worked?
Oh, absolutely. If you look at our stock, I think we're up 62% since we converted.
And how much of that, though, do you think is a function of the success of the firm, because you actually have had some pretty good earnings, relative to just simply changing the structure?
I think it's been both. So anecdotally, I would go meet with an institutional investor, and they would say, we love your fundamental performance. I can't own you. And that can get pretty frustrating as a public company. So I think it's both. The reality is we're seeing average daily trading volumes up. We're seeing.
Can we speak about the index issue, though? Because that was the other piece that was so interesting to me about what Carlyle did. Specifically, most of these firms, including your own, are dual-class structures in terms of the control. They decided to go with this one share, one vote approach, hoping that at least a Russell might take them because they historically have not taken them. I know there's lobbying efforts going on with S&P and others.
So Ares is in the Russell 2000. We gave voting rights to our shareholders. One of the challenges with all of these companies is we own 70% of Ares. So while we have great alignment with the shareholders, there's always a governance question as how do we transfer the ownership and governance over time to the public markets. Carlyle going to one share, one vote opens themselves up to be in the S&P indices. And that's the big difference. So I think everybody's the same way that they waited to see how stocks would perform, are going to wait to see how the governance and the index inclusion performs, and we'll hopefully see a second wave.
I ask this very carefully because I'm going to try to stay as apolitical as I possibly.
We got 30 seconds.
As apolitical as I possibly can. But we are in an environment where we've seen a couple of debates. When someone gets elected, and right now generic Democrats are ahead of the president, it's hard to pass all these laws that they're talking about. They wouldn't get passed. But do you think that if it was an outcome where a Democrat won, that the environment that you're operating in would be as positive? Or would that concern you in terms of your investments?
So, Joe, we try to stay apolitical.
Just what I said. But we're living in the real world.
Yeah, look, I think the good news is in the markets that we participate in, we are making good returns for our investors regardless of who's in the White House. And it's our job as fiduciaries for pensioners and insurance companies and retail investors to navigate whatever market they give us.
See how you do with Medicare for all and the Green New Deal.